To this story now, markets have been volatile for most of the week as investors assess the U.S. election results. A Trump victory has strengthened the U.S. markets and pushed up the dollar strength. Back home, the JSE has been blowing hot and cold, taking its main signals from the U.S. and Europe. The rand, on the other hand, has been strong for most of the past few months, but lost almost 2% as Trump was confirmed as the incoming president of the United States. Now, to help us wrap up this week's market movements, we're joined by Grant Nader, Benguela Global Fund Managers Senior Portfolio Manager. Grant, looking at this past week, it all happened. If it wasn't the US Fed, it was Trump being re-elected as the US president. The rand suffering 2.5% on that particular announcement. What would happen if the sustained rand weakness continues, especially for the local economy and households?
Yeah, good afternoon. It certainly has been an eventful week. I must say the rand has weakened a little bit post this election result, but it's also holding its own. It's still well off the lows at around 1780, and many other currencies have performed a lot worse against a fiercely strong dollar. Of course, we don't want the rand to weaken too much further from here, because the ultimate effect it has in South Africa is that it puts that inflationary pressure back on the table. And as we all know, we need to keep that under control. Our Reserve Bank is very strict when it comes to managing inflation, and that would dampen the prospects of further rate cuts. So it is something we need to bear in mind. Oil has maintained reasonable levels. It had a bit of a bounce, but it's also settling down, and that's another positive. So, of course, the rand oil price is something we need to keep an eye on from a South African perspective.
The US sneezing again last night, this time in terms of interest rates. The US Fed reducing rates by 25 basis points, a good sign ahead of the South African Reserve Bank's meeting later this month. Do you expect the SARB to view this as a time to also get more aggressive on our cutting cycle?
Look, I certainly don't see our SARB getting more aggressive, especially given the uncertainty that's going to play out with this new leadership in the US. However, the fact that the Fed cut last night, it does keep the door open for the SARB to cut, and it is widely expected that they will cut. And then again, we will sort of take our lead from there. There's still there's a fair probability that the Fed cuts again in December, which again keeps the door open for another SARB cut in January. But I do think at this point, given the uncertainties, one should temper the expectations for the amount of cuts in this whole cycle that we can expect without a bit more evidence of what kind of economic policies unfold out of the US.
Let's look at the company news. They're not really a heavy hitter, are Murray and Roberts, but have fallen in terms of share value quite a bit this week, speaking to just the weakness of the sector, but just the business itself struggling.
Yeah, I mean, I'm not too close to this one, but I do know that they are facing some troubles. There's a bit of a cash crunch, and the share has had a significant fall. This sector has struggled for many years, but within that, some of the stocks are doing well. There are some green shoots appearing, a government talking about rolling out further infrastructure spend. But we need to see that play out on the ground rather than just in the conversations in cabinet. So it's been a tough space. I think the prospects are getting better, but Murray & Roberts has some unique challenges in their own business as well.
Also some releases from retailers, some in the luxury space, some in the more household consumer-facing space. We had the Foschini Group releasing some results, still quite strong, but some concerns around the South African household and spending. Are most of the retailers in South Africa perhaps looking forward to December to try and bolster up those poor numbers?
Yeah, certainly. And I think if I look at the last 2 weeks, we saw numbers from the food and drug retailers, and we saw numbers from the clothing retailers. And there's a big difference between the two. The clothing retailers are not yet seeing the benefits of this improving consumer sentiment and all this expectation that is building around this economy and around the potential that we have as rates are cut, etc. So Truworths came out with a tough result. Pepkor was one of the better results, I mean, at least in terms of sales growth. And Foschini's was okay. If you take that all together, they are not yet seeing the tailwind that we all so busy pricing in the stock market at this point.
The demand weakness from China, but also the cost of living crisis hitting even a luxury owner like Richemont.
Mm-hmm. Yes, certainly. I mean, China's been a sore point for all the luxury retailers. Richemont is no exception. The China was particularly poor, but I do think relative to some of the challenges the other luxury retailers are facing, Richemont is holding up well, especially in its other major geographies. So a tough environment, but they're still suffering from a little bit of a hangover there post-COVID in China. And I think the widely expected stimulus that may come through in China will help settle that, or at least slow down that deterioration in that economy and help their sales.
As traders, as investors, what are you looking at in terms of those companies to focus on now that we know Trump is the US president, and which particular sectors are due to be strong?
Yeah, I mean, that's interesting because, he's not going to do anything that's going to benefit us directly, but there's certain sectors that could benefit an indirect consequence. If we see the rand weaken, that will be a concern for all our companies except the exporters. If we see the rand strengthen or stabilize, you might see better prospects come through in the rate cutting cycle and some of the macro improvements we've been looking for. What we also see is that China is going to have to step up their game in terms of counteracting some of the negative impacts that new tariffs in the US may have against them, and that will favor our commodity producers potentially. Well, hopefully, if they stimulate enough. So it's really still a bit of a melting pot. I think one needs to keep an eye on all sectors. What we don't want to see is the path to economic growth through maybe a GOA comes back on the table in the US. These are areas that could put some risk upon our manufacturing and sectors as well, and our agricultural sector. So I would be careful of those as well.